Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast, our weekly 2 cents segment with me, Pete Wargent from Owen Wargent Property Buyers, and I'm here with Chris Bates from Flint Group. G'day, Chris. How's things?
Things are going well, Pete. I'm feeling a lot better. So people have been tracking this week by week. I finally feel like I'm coming out of the doldrums here with health-wise. But been quite busy. I've been going away here. So up in Newcastle last weekend. We went camping the weekend before. And this weekend we're actually going down to Canberra for a friend's dad's got a farm. And I think it's a bit of a bush doof shindig that he's sort of organised where we do a bit of work on his farm during Saturday. And then we eat kangaroo and have a bit of a dance in the evening. So that's going to be an interesting adventure this weekend with the family. How have you been? What's been happening?
Well, I'm over in Western Australia this week, so I've got one of these Qantas round the world tickets, which I've never used before. But you get to use 4 or 5 stops, I think, and then so the first one is Perth, and we've been over here for a week. Very interesting, actually. I've been very keen to get over here and see what's happening firsthand. I can see that there's more homes being built out in suburbia because I think listings are so low. Listings are down another 10% this month and vacancy rates are like 0.4%. I think some people are so frustrated they're just getting into the house and land packages, so that's teeing off. But I think what's really obvious, you can't quite see behind me, but there's no apartment boom here. There's not many cranes around really. Bit of office space, bit of this, bit of that, but yeah, there's clearly no supply response from apartments at all. It looks very slow at this stage. But yeah, it's good to be here. I haven't been here for a decade for various reasons. 8 hours of sun a day, and I do enjoy it over here. We've done a few things like the Optus Stadium tour and all the touristy things. And but yeah, very interesting times here. The population is absolutely booming.
Yeah, I just talked to one of the top mortgage brokers actually there yesterday, and when you're on the ground there, it is interesting when you're driving around and you're sort of seeing suburbs and you're hearing what the locals are saying. What's their take on what's happening to the property market over there?
Yeah, it's pretty full on. So obviously I've spoken to a lot of people and clients while I'm here as well. I think, there's been a lot of announcements about apartment projects, but actually very little is actually happening. I think that's the obvious thing. Population growth here is about 3.5%. I think there's a bit of caution about whether we might see a repeat of what happened with the mining boom last time around. But I think the thing that strikes me is when I was here back in the mining boom days, you could see the supply response happening. A lot of apartments, and there was an overhang of supply around, just over a decade ago. But that's not happening just yet. I think there is some building you get further away from the city. But yeah, the apartments thing is just not making any sense for developers. So yeah, there's just a crush load of people trying to get into the market. The vacancy rates is basically zero. Interestingly, there are retail vacancies and office vacancies, but just in the residential market, there's nothing. So there's, I think there's a little bit of caution, once bitten, twice shy, but just looking at the stats, the listings numbers are plummeting, vacancy rates can't go any lower. So I think we're going to see the blow-off phase of the cycle for sure. And in fact, it's already underway, which is one of the stories we'll no doubt cover off this week.
Yeah, I mean, do you think there's a bit of the East Coast rose-coloured tinted glasses that, haven't bought in Perth before, never probably even visited Perth before, and they're just buying the hype and they're buying over there, not what the locals or what, in areas that, I guess the higher end or more the aspirational part of the Perth market. Is there a bit of that talk where, the locals are saying, what are these investors doing? You hearing a bit of that?
I've heard a few people, so in fact, a few people have asked me straight up, are you over here buying property like everybody else from the East Coast? So there's a bit of a negative vibe towards that, which I'm not actually. I'm purely visiting for, really just for a holiday and a bit of research. But I think there's definitely a cyclical element, and the investors amplify the cycle these days. And there's definitely been a lot of investment piling in from the East Coast. Interesting times, but it's a very interesting place. Perth generally, I think it's a fabulous lifestyle. You can see the wealth that mining has created Like the Optus Stadium, for example, just paid off. The government's just paid it off, and it's an asset for the state. And so many projects, and just everything, the cleanliness of the buildings and the council offices and things like that. It's very eye-opening when you come from Europe, for example, where things are deteriorating by comparison. You can see the mining wealth, and even just looking around the CBD, the big tower blocks of BHP, South 32, Woodside, Rio Tinto, etc., etc. So it's not difficult to see where the money has come from, and a thriving place, but with a few challenges as well. And of course, very isolated. It's a long way. 6 hours on the plane from Brisbane being the main disadvantage, I think.
Yeah, I wonder if it's more than a mining town or a mining city. Is it going to become a fully fledged economy? And I think Shaw and Partners, a massive financial planning business, just invested in a huge office there, and that's trying to capture a lot of that ultra high net wealth in Perth. And there is a lot of money there, and I think there's been a lot of pent up demand in the upgrader market, because there was this feeling that you could upgrade, but there was no urgency to do it. So I'll upgrade when I need to upgrade. I won't upgrade in advance. But if you think the prices are going to run on you, then you bring forward your upgrade, because, if I don't do it now, then I might not ever be able to do it. I think that's going to have to start playing out in Perth, particularly people who needed the equity growth to do the upgrade. So a bit of growth creates more growth. And I think there's a positive feedback loop. And then also bringing forward some upgraders who are, well, actually, let's get in now, and we can. And there is a bit of an affordability sort of crunch, obviously, with borrowing capacity. And so the Perth market doing so strong in the face of, huge headwinds, right? You can't argue that borrowing capacity is not really tight. You can't argue that there's fear around interest rates still going up, and the rates are ridiculously high compared to where they were. And so, that's our first story right this week, Pete. Obviously, every week we cover 3 stories that are happening in the market. And do you want to get stuck in on number 1?
Yeah, let's do it. So CoreLogic released its monthly update. I think this is almost a bit like a mirror image of what we saw around 2012. I think there's a tendency, I think, for a very East Coast-centric view of the world, especially if you think about where the Reserve Bank and the regulators are all based. It's all around Sydney CBD. And so almost it's very reflexive. I suppose the people they speak to, the local businesses, people in the local housing market. Of course, Perth and to some degree Darwin and Brisbane moved to a different cycle because of the mining cycle. And the vibe you get being on the West Coast is there is no need whatsoever for interest rate cuts. If anything, it's the opposite. So things have obviously been very strong here. Commodity prices have been high, engineering projects, people being sucked in from other parts of the country. So yeah, CoreLogic's monthly update on the housing market. I also got the chart pack today, which I went through, which is very interesting. So Perth housing prices were up 6% over the quarter to April. So obviously that's the strongest in the country. No sign of supply response just yet, as I mentioned, although you can see a little bit of the house and land thing teeing off now. But clearly the boom has got a way to run in Perth. There's no question about that, just the sheer weight of demand versus the lack of supply. The only city to not record any price growth over the quarter was Melbourne. In fact, monthly just going backwards very slightly. So it seems to be, if you look at it overall, conditions seem pretty solid. I think the chart pack, some interesting trends there. Lending settings look like they're as tight as they've ever been, really. The share of risky lending is at pretty much record lows. The rental price increases are continuing, if not accelerating. That largely seems to be now a capital city thing. And I suppose the one interesting thing from the chart pack, Hobart was the only city where house prices are increasing faster than apartment prices. So I think that's an affordability issue that you mentioned, Chris, that more borrowers have seen their borrowing capacity is reduced. It's pushed people down into the lower price points, under 800K in particular. And in some capital cities, that basically means you're buying a unit, not a house.
Yeah, absolutely. I mean, the supply of, new apartments, a lot of investors have sort of been educated over the last few years that the ticket to wealth creation isn't buying off the plan apartments. And, they've either had an experience of spoken about or read about in the papers or even just looked at the data, right? And I think that's not going to a lot of the investors going over to Perth aren't buying new apartments, right? And so, the developers can't sell it to make money because of the cost of construction, and even though land would be cheaper, investors aren't there to buy them. And a lot of first-home buyers are going, well, I want to buy a house. That's where the growth is. So I think that's what's definitely happening over there. I do find it interesting that, that if you look at supply for the housing markets, it's much tighter than unit supply, right? So well, listings are higher, but if you look at the amount of listings that are in the apartment market versus housing markets in a lot of places around the country are at decade lows. And if somewhere like Brisbane, it's ridiculously tight. And so, to be getting price growth in the apartment market, even though supply and listings are higher, is a good sign to show the depth of the first home buyers and the investors out there. But however, I do think because there's a lot of listings out there, it shows that there's a lot of investors leaving. And I would say there's more investors leaving than entering. Even though the numbers look like this is an investor boom, I still, particularly with this concern around interest rates, really in Victoria, it's really prolific how much they've targeted the investor down there, and everything from the land tax and, rental changes and, et cetera. So, I think I did find that. I just read the chart pad before this, Pete. It came through, not that long ago. And I thought that was a really interesting one around the unit growth over house price growth. I wouldn't have suspected that. I do think that you can see it's obvious why the lower end of the market's performing really well here. But I don't think that's really a long-term trend, right? Because if a cheaper suburb grows at a faster rate than a more expensive suburb, someone then ultimately says, actually, if I could live somewhere better and that gap isn't that big to make, I will make that jump, particularly when I'm confident and I've got the borrowing capacity to do that, and I'm confident where rates are and et cetera. And so, yes, you might get a little bit more growth in the lower end of the market because there's issues around rates and affordability, but I wouldn't expect that to continue over, 5, 10, 15-year periods, just because ultimately you wouldn't pay more for a suburb that's further away from the city, like it's just technically that's usually not what would happen. So I think that's getting driven by capacity restraint.
Oh, for sure. You're definitely right. It's interesting to look at the texture of the latest monthly report. So Brisbane housing prices are up 3.1% over the quarter, Adelaide 3.3%. So you could say, yes, combined regional prices 2.1% over the quarter. They're not as strong, obviously, as Perth, Adelaide and Brisbane, but still solid growth across regional Australia nonetheless. I think as well, to your point on investors leaving the market, you can actually see this in the chart pack. If you look at the number of new listings, they're not very high, but they're certainly higher than they were last year or the year before for this time of year. So total listings are starting to pick up just a little bit. I wouldn't say it's anything dramatic. And so, they're very low overall, 138,000. That's still about a fifth less than you'd normally expect to see for this time of year, but there are more investors leaving the market. You can see it as a buyer's agent because of the number of properties that are listed for sale, which are still tenanted. That's the obvious sign that you're buying from an investor who has most likely bought an investment property at a mortgage rate of 2 or 3%. Now mortgage rates are nearer 6 or higher, and it's not making much sense. And I think some people are just taking the opportunity to tap out. So, there's a few interesting nuances there. But definitely more price growth around the lower price points of the market of late, because those tighter borrowing capacities are just starting to bite now.
Yeah, I think that's a good little wrap up of what we're seeing, Pete. What's your sort of take on, let's go to story number 2.
Yeah, so story 2, it's a bit of a catch-all. It's on just the latest apartment trends, the good and the bad. So a few interesting articles over the past week. Neither Sweeney in the AFR, city bolt holes are the next must-have for baby boomers. And there's definitely a lot of that happening. Simon Kustenmacher at an event I spoke out last week on the Gold Coast from the demographics group was saying there's an awful lot of people now looking to position themselves maybe within an extreme commuting distance of the capital cities, which he takes to be around 2 hours. But for a lot of people, and I know a few of them actually on the Sunshine Coast, they're thinking, actually, if I'm going to be working in Brisbane 2 nights a week or 3 days a week or whatever it is, then I might well actually want to just have a CBD apartment or a unit that I can crash at. Often that would probably mean a smaller type of crash pad. There's definitely that. But I think there's some, despite price growth the units outperforming of late. I think there's also some hidden risks here. It's a very tough time for a lot of strata and body corporate schemes. Costs are up, repairs have gone through the roof at the prices. Now, there is a flip side to this, despite strong price growth for a lot of units, and that is that it's a very tough time for a lot of strata and body corporate schemes. Costs are up very sharply. Repairs costs have rocketed, maintenance costs, but particularly insurances, often up more than 50% over 4 years. So there could be a lot of special levies coming down the track. But overall, there's just not much being approved at the moment. The one place we're really seeing unit approvals working is places like the Gold Coast or Redcliffe, where units can be sold off the plan with ocean views. But for middle ring suburbia, unit approvals are just outright tanking. Sydney, Melbourne, Brisbane, and there's just not so much happening there. So there's a lot of diverging trends here, even within the unit market, and not all units are created the same, Chris.
Yes, absolutely. You do need to do all you do DDT around buying strata. It's one of the steps I think a lot of buyers can miss, just in the, getting caught up in the market and looking at lots, and then all of a sudden just overlooking it when they do finally find the right place. And once you've signed that dotted line, it's hard to get out of these buildings, particularly if the issues are known and or they become known. And so be really careful. A lot of people think you're protected when you're buying strata, but it can't be more the opposite. It's interesting. This article popped up, and before you put it on the list, Pete, I actually thought, hang on a sec, we've seen this. It's a little trend I've noticed a few times. North of Sydney, a couple lives on an island. We're commuting more and more for work, and they've come and bought an apartment just so they can spend a few nights in the city. But they're not downsizing. So that's interesting. This article was more saying, that the retiree that wants to come to the city, and, a lot of them can't find rentals. They can't find it, hard to get an Airbnb. So, having something regular and being able to leave stuff in the city rather than bringing stuff back and forth is a really good option. The other one was actually the opposite, south of Sydney. They were a family, and but they were coming to the city more and more, and just having somewhere, a studio apartment near work was really handy for them, just to crunch out a few bigger days at work and then having a few more days at home. And so that's absolutely something we've noticed. I wouldn't say it's going to be a huge part of the market, right? Because you're only looking at the people who are trying to commute from these, 1 to 3 hour probably ones that do have a lot of pressure on getting into work, ones that want to make that lifestyle sacrifice. But I do think there is that in the market now, which I haven't really seen before. A lot of people have talked about it, but when they look at the fundamentals of actually owning it versus just renting it, it just didn't make sense. But I think the rental crisis and how difficult it is just to rent something like that is causing people, well, I'll just buy it. And that's what a lot of people do with the property market. Like, even when their kids are finding it hard to rent something, you find a lot of parents buy them an apartment if they've got the capacity to do so, because they want to solve their problem for their kid renting. It's funny how people react.
Well, it's one of the paradoxes of the housing market, isn't it? The wealthier people get, the more housing they buy. I've seen some stats out of Europe recently, and they're talking about the number of dwellings per person having increased over the past 50 years. But there's so many people now who own a home, a holiday home, a rental home, one for the kids. That seems to be what happens as people get wealthier. They just buy more property. So the supply side of the equation is not quite as simple as every 2.5 extra persons requires one dwelling. It's more malleable than that. I mean, on that point, actually, the building approvals figures, and this showed up in the CoreLogic chart pack as well, but the ABS figures showed that house approvals are kind of holding up, which is nearly all due to Perth, actually. So the aforementioned house and land movement in Perth. But if you look at unit approvals, they're just dire. In Brisbane, they're back to where they were around a dozen years ago. Same in Sydney, same in Melbourne. So overall, only 162,000 dwellings approved over the past year. So that's the lowest in about 12 years. When you drill into the figures, you can see why. The cost really is about 50% higher than pre-pandemic. Construction costs with the average approval value, it's up by about 50% over 4 years. So I think if you look at that overall, the housing market is going to be undersupplied for most of this decade. I think the forthcoming budget is going to talk a lot about build to rent. So there'll be withholding tax concessions for developers wanting to do build to rent projects. There'll also be accelerated capital allowances. So I think if you look at the EY modelling, they're kind of hoping or expecting that build to rent might add, say, 150,000 units over the course of a decade, which is not insignificant, but it's not really going to tackle the overall issue. So there'll be a lot of focus on build to rent being the Labour side of politics. But yeah, the big picture is there's not much being built except in certain pockets and coastal areas, and it looks like an undersupply over the next few years.
Yeah, and I do think that the downsizer will continue, right, when they can sell out of the city and, the market's really hot and, they do take that opportunity at some point, particularly if their kids have to leave the city as well and they'll follow where they go. And so we've seen in previous booms where people, the retiree downsizer does take their money and run. And so I do think you're going to see that, and then potentially buying a little apartment in the city is a good option. You can see that a lot of cash buyers have been buying apartments in somewhere like Carlton in Melbourne, for example. What are they doing with the rest of the money? Well, they're putting it into their super, and maybe they're buying something regionally, etc. So this place where retirees have two places, I do think that's going to continue. It's a pretty good life if you can afford it. You get the city and the country life. So yeah, that's a good story, that one. What's story number 3, Pete?
Well, the third story is just on the latest lending trends. I always like to talk to you guys because I know you see a broad range of investors and indeed home buyers in the market. So it's always interesting to bounce some of these numbers that the ABS releases over to you and see if you're seeing the same thing. So let's look at the latest housing finance figures. Lending was up 17% over the year for housing, so much stronger, but still below previous highs. Construction lending, still pretty low, not much happening there. It does seem that new investors do seem to be getting back in gradually. One of the numbers that jumped out, average loan sizes for investors hit a record high, around about 630,000 or thereabouts. Now, I was wondering whether you're seeing some of this. Now, is that partly because some lower income earners are shut out, or is it because wealthy baby boomers are piling in? Reason I asked the question, I saw a bit of data out from CommBank, and they said now that the market for investors is really being driven by millennials. So if I remember correctly, millennials are born between 5 years after me, so 1981 to 1996 or thereabouts, and that's about 46% of CommBank's new property investors, followed by Gen X, which is about 37%. So I think the CommBank said their average investor is about 43 years of age and borrowing about 500K. So does any of that map across to what you guys see, or do you see something different?
Look, I do think there's people who have got a place and they do want to upgrade, but they can't, and so they're buying an investment property. I do think there's a bit of the person who's got a lot of equity in their home and a low mortgage who is, actually this does make a pretty good time to invest. So they're in a good position. They know that they should have done this in the past, and they see that when rates go back down and borrowing capacity goes back up, even though prices have been holding, it's a good time to buy a property. They see that, they sort of understand that when rate cuts come, that, that should lead to price growth. Not to say that's exactly what will happen. But I think that millennial story, particularly maybe not 43, but maybe 33, is a lot of those investors are first home buyers that can't afford to buy a home, but are buying an investment property. The rise of the rent vesting is absolutely increasing again. The reason is, it makes sense to, hold an investment property because it's all tax deductible versus owning a home because it's really expensive when rates are high. And you go, well, I can rent cheap, and the rent plus my negative cash flow on a property is way cheaper than me actually buying a property to live in, particularly if you live at home. And I think this is another thing that's also happening is the way the borrowing capacity calculators work. If you buy an investment property, if your rent is really cheap, i.e. you live with family, banks will use a notional rent, but you can borrow more for an investment property than you can for a home. And I absolutely think there's a bit of a rise of people moving back into home, or they're keeping their rent really cheap. They're buying an investment property, but in turn, they're actually turning that into a home. So we'll go down in the numbers as investment lending. But ultimately, I think they're actually homes, or they're going to be sold at some point because someone's going to take them. If they get any growth, once their income goes back up, once that goes up, once they maybe meet a partner, maybe once borrowing capacity goes back up, once there's more pressure from a lifestyle point of view, as in kids come along, they all of a sudden say, right, we need to get a home, let's sell our investment property. So millennial investors, generally aren't the best investors, you would say. There's probably what you want is that investor that's cashed up, got heaps of equity in their home, and is going to buy something and hold it long term. That's great for our long-term rental stock. But a lot of the millennial investors take their money and run. And so I would say this is one of my concerns with this sort of lower affordability-driven investment boom, is if those investors are that type of investor who's going to take their money and run, what will they do? The first sign that it's time to get out, they will sell. And very quickly you can see where a supply shortage becomes a supply, too much supply. And the locals can't afford to pay those prices because the investments have competed them up. And I've made this point before, but, I can easily see how that could flip back the other way. And so just be really careful of, investors are buying them, but who are they? What are they? What are their wealth? What would they do are they long-term investors? Or are they just trying to make some money and run it? A lot of people don't think that deeply about it. They just think, prices have gone up a lot over the last 6 months. This is, great times. I bought an area that no one knew about. And I think that's definitely the case that's getting perpetuated out there.
I think the thing that struck me when I saw this stat from CommBank, in 2023, millennials represented 46% of CommBank's new property investors. You know what this reminded me of? I remember years ago, people saying, the new trend's going to be computer games. It's going to be Tamagotchi. It's going to be video arcades. It'll be yo-yos. And every year it would just be music. There'll be fads that come and go. But the main thing that young people are going to be interested in, music, the latest release, live events, festivals, concerts. And it always just comes back to the same thing. It just reminds me a bit, over the past, say, 15 years, I've heard so many people say, well, young people, they're going to move to Southeast Asia. The fire movement's the new thing. Or, they're going to be going traveling or taking sabbaticals, doing whatever. But in the end, it still comes back to property. I think most people in Australia who are aspirational do actually want to ultimately own property. And now the bank of mum and dad is powering this along at the moment. Lots of deposits being gifted or inheritances passed it on early. I think there is a downside to this, as you said, and that is I've heard a lot recently about tenants being forced out because landlords have got into the market in the past year or two, but they weren't really serious about being long-term landlords. And I think this is where Labor's argument comes into sharp focus. Labor is saying, well, it's not really fair that a young family should have to compete against a greedy investor buying their third or fourth rental. What they want, they should have a security of tenure for people who want a long-term lease. But I suppose the flip side or the irony to that is that under the build-to-rent model, developers or pension funds could ultimately own thousands of units. So it is a bit of a paradox, I suppose. But it's interesting to me that the idea that millennials wouldn't be interested in property was clearly proven to be false by the fact that most of the biggest cohort now of investors is actually the millennials.
Yeah, I don't think, if you go back sort of 2015 time-ish, there was that millennials, the rent economy, I'll just rent and I'll just use my Airbnb and I never want to own a home and never going to own anything. That mentality back then hadn't really, I guess, the foresight of what would happen to rental markets and is it really going to be that easy to rent a home? And that was like a proper investment boom and it was easy to rent, etc., and rental oversupplies, etc. I think the last 3 years in particular with how much rents have gone up and how difficult it is just to get a rental. Imagine lining up in a 40-person queue. That's traumatic, right? Particularly if you've got to move out of a rental in 3 weeks' time and you haven't secured something. Imagine the stress you're going through, particularly if you haven't got any family or friends to help. You're bordering on homeless there. And so that I think is absolutely played out in markets. And people are like, well, I ultimately do want to own a place long-term. And I don't think that's ever really faded. That Australian dream is still alive. And all the surveys, they come out and, you might think, they don't want that. But then when you do the survey, they say that percentage is really always stable. I do think people lose hope with it. So they say they don't want it, but ultimately they do want it, right? So they just don't think it's achievable. And, I think that's absolutely what a lot of investors are right now, are those people who ultimately want to own something to live in, but they're just doing something because it's better than leaving the money in the bank, and they're worried if they don't do something, they're not going to be able to do something in the future. And that's danger money for investors, because ultimately they will take their money and run because it means so much to them as well, because they haven't got other resources. And I think that an interesting thing we're seeing is absolutely Jarden did some research, popped out that, the deposit level of first home buyers is, really low right now, as in that first home buyers are getting the most help they ever have from family. And I think what you say about people buying multiple homes, that rental crisis is feeding into parents, is feeding into grandparents, and it's bringing forward that intergenerational wealth more than I've ever seen. And, all the research backs that up. So yeah, people on higher incomes are borrowing, but also the people with the wealth passing down would be the case. The interesting story we haven't spoken about this week, Pete, I know we're running close on time, is all the banks have released their results and they're all crying poor, but they're also giving billions back to their shareholders. So things can't be that tough if you're giving billions back. What they're also doing is trying to throw mortgage brokers under the bus and blame mortgage brokers for them not making as much money. And, it's quite amusing for us to watch this, because mortgage brokers' market share has been increasing, pretty consistently, all the way back to the early 2000s, right? And it was once 0 market percent share, right? Then went to 1-2%. We're now talking, potentially up to 75%. A lot of the big four banks are getting 60% of their loan flows through mortgage brokers now, and 40% through their branches and their networks. The war's sort of over, right? Brokers have got a great value proposition, and, there's a lot of them out there, and they're doing, and consumers are going them because ultimately they're giving them choice, and also they're driving bank profits down, and they're actually putting that money back in their pockets. And so just be really careful reading these stories, because mortgage brokers are actually great for consumers. And the reason banks are getting upset with them is that they've been driving their profits down. And I think it's a bit of a canary in the coal mine. The banks are going to try to bite the hand that feeds them, because ultimately they're seeing that the profitability of that isn't like it was in the 90s, and they could just, print, double-digit credit growth and make massive NIMs and, just print money for fun. They're actually having to work and actually be a bit innovative and come up with better products and services. So, I do find it funny when banks are crying poor, but also, giving billions back to shareholders.
Slight increase in mortgage arrears as well, not to high levels, but there's definitely some mortgage stress around. It reminds me a bit of the Banking World Commission. Who can we throw under the bus here? It can't be us, it has to be somebody else. I think a lot of this has come around as well because of the macro prudential settings, which is locking out so many first-time buyers and so many lower income earners that banks are having to find other ways to pump up the revenues and the profits. So, and final point for this week, just on the intergenerational wealth point, I saw Simon Kustenmacher talking about this last week, and he said, yes, it's been brought forward, but the peak of the wealth transfer doesn't happen for nearly 2 decades, 2043. So this is not something that's a one-time event. It's going to be going on for the next 20 years, all those boomers and the elder generations passing on their wealth down to the younger folk. So that's an ongoing issue for the next 20 years. Out to 2043. So just to wrap on this week, Perth leading the way with 6% price growth over the quarter, but Brisbane and Adelaide also over 3% over the past quarter. Apartment trends, apartment prices are rising faster than houses in most cases, but there are some issues in body corporates, so keep an eye out for those, and approvals are just really falling away. They're very undersupplied there. And then finally, average loan sizes have increased for investors. But I think that's partly a compositional thing. It's not necessarily that people are leveraging up more as a result of the settings that we've got in place. I think we've got budget coming up, Chris, so lots to talk about over the next week or two, and no doubt plenty of controversy as well. But shall I get back to it? I know you're very busy.
Absolutely, Pete. Let's have a chat next week. I think we're going to do our first live, so I think it's going to be 12 o'clock on a Friday. So if you want to start tuning in on those, I'm not exactly sure that's going to be the time forever, but we're going to start to try to do these live, which you'll see how many mistakes Pete and I make. Look forward
Usually
to it.
with the tech.
We'll still release it on a Sunday, so you can still get it on a Sunday, but we'll do it live if you want to join in the fun and ask questions along the way, a little bit more interactive to this. So hope you enjoy your flight around the world, Pete, and we'll be staying in touch every week in the meantime. So thanks for listening.
Cheers, Chris. Yeah, it'll be a test for the National Broadband Network, but hopefully the tech will hold up this time. So, yeah, look forward to seeing you next week and have a great weekend, everybody.
Thanks a lot. Cheers.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.